Okay, well, tonight we are going to talk about the TFFR plan. So folks, TFFR is one of the oldest retirement plans in the country. It was actually established in 1913. So it's actually over 100 years old. It was named something different back then, but TFFR stands for Teachers Fund for Retirement. And throughout this presentation, I'm just going to talk about TFFR. But it is a defined benefit public pension plan that was established to provide retirement benefits to North Dakota educators such as yourself. The plan operates under Section 401A of the Internal Revenue Code. It is tax exempt and governed by North Dakota Century Code. It is designed, or it was designed, to ensure long-term financial security for educators and is funded through contributions and investment income, which we're going to talk about or talk a little bit more about in a bit. So the plan is administered by the TFFR Board of Trustees, which, among other things, oversees operations, it sets investment policy, and recommends legislative changes. The board is comprised of the state treasurer, the North Dakota State Superintendent of Public Instruction, and 5 governor-appointed members, including 1 active school administrator, 2 active teachers, and 2 retired members. And all of us staff members, such as Sarah, Denise, and myself, we work for the North Dakota Retirement and Investment Office, otherwise known as NDREO, which is a state agency and manages not only the teacher retirement program, but also the state investment program. And I should just say, Denise and I do not work with the state investment program, but RIO, the agency, not only oversees the TFFR program, but also the state investment program. TFFR operates on an actuarial reserve basis, meaning funds are invested during members' active teaching years. And so all of you that are active teachers, you're paying in your contributions. So during the members' active teaching years, you pay your contributions in to finance future retirement benefits. The plan's funding sources include member contributions, which is 11.75% of TFFR eligible salary. It's also made up of employer contributions, which is 12.75% of eligible salary, and investment earnings. So currently, just to kind of put things in perspective, TFFR serves about 11,800 active members. We have a little over 200 employer groups, such as schools, education associations, there's a few state agencies. So again, a little over 200 employer groups with over 9,600, I think it's just a little less than 9,700 retirees and beneficiaries receiving benefits. So that ratio of active members to retired members are actually getting, closer and closer together. And this slide just shows a pie chart of the funding sources. You can see that the investment income is a big part of the funding status. Oops, sorry. Okay, so let's talk about membership. So membership in TFFR is mandatory for licensed educators contractually employed by a North Dakota public school or other organization that is organizations for teaching, supervisory, administrative, or extracurricular duties. And members are classified as either Tier 1 grandfathered, Tier 1 non-grandfathered, or Tier 2. So let's talk just briefly about each one of those. And maybe I should just explain a little bit about what happened legislatively. So for many, many years, almost 100 years, we only had one group or one tier, one benefit structure. And in 2007, I think that was the 2007 legislation, actually broke the group into 2 tiers. And so if you had credit on July 1st, 2008, you were part of the Tier 1 grandfathered. If you were a new member joining July 1st of 2008 or later, you became a Tier 2 member. And so for 5 years, we had two tiers, Tier 1 and Tier 2. Well, then in 2013, legislation split the Tier 1 group into two groups, Tier 1 grandfathered. To be grandfathered, you would have had to be within 10 years of normal retirement. In other words, you would have had to be at least age 55 because you would have been within 10 years of age 65, or you would have had to be within 10 years of attaining the rule of 85. And so we're going to talk a little bit more about the rule a little bit later, but that's how the tiers were split. So again, we only had one group for many, many years, and now we have three: Tier 1 grandfathered, Tier 1 non-grandfathered, and Tier 2. And I hope that all of you know which tier you belong to, and if you don't, you will be able to see that in your My TFFR self-service portal. And also, if you are if you have any questions about that, please let us know. And then also that last item there, a veterans exemption allows first-year teachers with 20 plus years of full-time military service and military retirement benefits to opt out of TFFR membership within their first year of teaching. And this was new legislation, I believe, in 2023. I think that's when it was. So far, I don't think we've had anybody take advantage of that. But again, that exemption has to be elected that very first year of TFFR covered employment. Okay, so let's talk about salary. So you as a teacher, and by the way, I used to be a teacher back in the 90s. You're expected to do a lot of things. Sometimes you get paid for them, sometimes you don't. But you as a teacher, you do get compensated for all different kinds of duties, and not all of that compensation could be considered eligible TFFR salary. So we need to look at what's reportable and what isn't reportable to TFFR. So TFFR eligible salary includes all earnings from teaching, supervisory, administrative, or extracurricular duties reported as taxable income, including amounts deferred for things like 403Bs and flexible spending accounts. Now, what that means, that last bulleted item means, is that and let me just give you an example. So if you have a contract that's $60,000 and you tax defer, a total of, let's say, $2,000 in a 403B account, what's reportable to TFFR is still that $60,000. Now, what's reportable to for federal income tax would be 58,000, because that's a tax deferred. If you're tax deferring 403Bs, then you don't have to pay income tax on that amount that you tax defer. But for TFFR purposes, we want to make sure that your school or your employer is reporting that full contract amount to us. Same with like flexible spending plans. If you're having money, tax deferred and put into a flexible spending account, you want to make sure that they're not reducing your salary and then reporting it to us. They need to report the gross salary to TFFR. And you do have to pay contributions on that. But the important thing is that we get your retirement salary correct, because your benefit is based on your retirement salary. So we want the schools and the employers to make sure that they're reporting correct salary to us. Now, actually, I'm going to go back up to that slide. Examples of eligible salary, other than like teaching. So some other examples could be pay for coaching or advising, mentoring. I know there's a lot of you teachers out there that do curriculum work. Professional development is reportable to TFFR. Summer school, adult education, paid leave, as opposed to unpaid leave, which we'll talk about in the next slide. And then any other extracurricular supervision or duties. So all of those are examples of what is reportable salary to TFFR, along with your regular teaching contract or administrator contracts. So certain types of compensation are not reportable to TFFR, and these include bonuses, severance or retirement incentives, bus driving, janitorial pay, fringe benefits, insurance or expense reimbursements, unused leave payouts, that is not reportable to TFFR, or any other non-teaching duties. And also payments made in anticipation of retirement or termination are also excluded. And let me just give you an example of something else that is not reported, and that's conversion of fringe benefits. So it says right on your screen there that fringe benefits are not reportable, but neither is a conversion of a fringe benefit. And a good example of that is there are a lot of small schools in the state of North Dakota, and a lot of those schools may own houses and have their teachers or administrators live in houses, and so they may get a housing allowance, and so if you're getting a house allowance or even a health insurance allowance, and then the next year you say, you know what, I don't need that allowance anymore, just make my salary higher. Well, that's all fine and dandy for the school to pay you. They just can't report that conversion of that fringe benefit to TFFR. So they can pay it to you, they just can't report it as salary. And so that would be an example of a conversion of fringe benefit that is not reportable to TFFR. Then we're going to go on to the next topic. Now, it might be a little weird to talk about beneficiaries at this time, but when you become a teacher and you start earning salary and your school has reported salary and has paid contributions, and so all of you on the call, you're not new teachers. I don't know that we have any new teachers on the call tonight. And so all of you have an account balance. It's important that the beneficiaries that you have named are the ones that you want to be on your TFFR account as a beneficiary. Mainly because TFFR, members, you have to designate a primary beneficiary to receive benefits or for them to receive benefits upon death, whether you pass away as an active teacher or a retired teacher. And so married members, it's actually North Dakota state law that married members must name their spouse unless the spouse has signed off on a form as their primary beneficiary. You can name contingent beneficiaries, but it's only required to name a primary beneficiary. You can name one primary beneficiary or multiple primary beneficiaries. You can name any person, organization, church, charity, or estate. And again, if you're not married, you have to have written spousal consent. Or if you have written spousal consent, you can name any other person other than your spouse. One thing to note, if you name more than one primary beneficiary, they are not eligible for a lifetime monthly annuity. So think about your situation right now. Think about who your beneficiary is. And if you don't know, it should be found, you can find it on your My TFFR online account. Make sure that your beneficiary is who you want. If you have multiple beneficiaries, like for example, if you have your spouse and kids on as primary beneficiary, then if you were to pass away, your spouse would not be able to get a lifetime monthly annuity. And so you are able to change those beneficiaries. Denise, you might have to pop in here if I'm saying this incorrect, because now with our new system, it is a little bit snarky sometimes on who can change beneficiaries. But just make sure that if you want your spouse to have a lifetime beneficiary or lifetime benefit at some point. They do have to be the only primary beneficiary. And again, you can name kids as contingent. And if you're not married, you can name anybody as primary beneficiary or any organization, church, charity, or estate. I do have a couple of other examples. So these are real life, I guess, examples of what has happened. But I guess I've talked about a couple of them. So I don't know how many times over the last 25 years that I've worked here that a person has passed away before retirement and they have named spouse and kids as primary beneficiary, where that spouse could not get the lifetime benefit. We've also had a situation where the ex-spouse was still listed when the member passed away, and the new spouse was wondering why we couldn't pay her. We also had a situation where, again, an ex-spouse was listed as primary beneficiary, and that person absolutely did not want to take any money from this account from that person. And so she had to disinherit it, but she did have to hire an attorney. That does have to go through the courts. And so we just don't want you to get into a situation like that. There's also been multiple cases where parents have still been on as primary beneficiary and instead of the new spouse. And again, the spouse, it is state law that spouse has to be your primary beneficiary unless you've signed off, unless the spouse has signed off. But if you're newly married and you forget to name your spouse as primary beneficiary, and if you pass away, spouse can get the benefit, but that does have to go through the courts. In summary, make sure you check who your beneficiaries are and make sure you update your beneficiaries if needed. Denise, do you think now would be a good time to maybe just show them how to do, or not sort of how to do it, but where they can do that?
Sure. Yeah, it can be
you
a
see
little.
this?
Yep, we can see it.
Is it? I think Denise was going to say it can be a little tricky.
Yes, I was.
So this is a screenshot, I guess, of a self-service portal. So when you log into your account, you can see there's a tile here called My Beneficiary. The tricky thing is here, so if you click on that, you're going to look at this and you're going to say, oh, that's my beneficiary. But up here it says My Relationships. So the new system does give options to add relationships that's not necessarily a beneficiary. So if you want to look at your beneficiaries or view your beneficiaries, you click on this button and here are your beneficiaries. So you can create new relationships. So let's say you want somebody for contact purposes. That's all fine and dandy, but make sure that your beneficiaries are who you want. And by the way, in order for you to assign or update your beneficiary, you do have to create a new relationship if it's not already created. Denise, did I say that right?
Yes, yep, you do have to be on the previous page and create a relationship before coming to this page to apply them as a beneficiary.
Yep. Okay. And then one other thing with the marital status, Denise, can they go in and update their marital status or do they have to go through us?
They can.
Yep.
Nope, they can do it they can hit that update marital status and it'll take them right to their profile to update it.
Perfect. Okay. Okay, sounds good. Denise, anything else do you think I should talk about there?
I don't think so, but I do see that there is a hand raised there.
Oh.
I do have a tip for you though too. I was going to say if you didn't catch all of that or you didn't remember all that, actually when you go onto our website, there is a link on our website under TFFR member that takes you to some short instructions on how to do that, including, I believe there's a link in there to the video that walks them through the process. Yeah, there's a how-to video on there, but also I'm just going to quickly steal your screen.
Oh, sure. Yep.
And when you go onto our website and you go to the TFFR member page, can you guys see that right now?
Yep. I can
Okay,
see it.
so when you go to the TFFR member page, if you go down to account update, right there for user guidance, it tells you how to use the help button to access the update information, and alternatively there is a how-to video. But if you, like Denise Langing Sargent said, sometimes it can be a little tricky. So if you do struggle with that, you can actually on the homepage of my TFFR, and I'll stop sharing now so you guys can have your screen back. You can use the contact us tile to submit a request for assistance. So Brenda, I am going to unmute you so you can ask a question. And let me see if that will allow microphone.
I don't
Okay.
know.
Yep.
Brenda,
worked.
go
Okay.
ahead.
So my question is, I have my husband down as beneficiary, but I have my 3 children down as contingent beneficiaries. That's okay, right?
Yeah, do you want to
Yes.
explain the difference, Denise?
Yeah, actually, I'm glad you said that. But yes, that's what most people do. If that's the way you want it, that's what most people do. And that would give your spouse the option to take that lifetime benefit if you were to pass away before you go through retirement. And then once you do go through retirement, by having him as the only primary beneficiary, it does give you those joint survivor options that we're going to talk about here in a bit.
It's
Okay.
when you list multiple multiple primary beneficiaries, they cannot all have a lifetime benefit. You can only have
Right.
a lifetime benefit if there is one primary, and that is typically your spouse or someone within, what's the age range? Is it 10 years, Denise?
10 years. Yep.
Yep.
And
Okay.
yep, that'll be another slide. I will mention that in this situation, if the spouse is the primary beneficiary and the kids are contingent, what a lot of people ask, well, what will happen if you both pass away at the same time? And you hate to think about things like that, but if you were both killed in a car accident or something, then we will never keep the account value. We're going to talk a little bit more about the account value, but your account value does have to be paid out to first you, if not you, your primary beneficiary. If both you and primary beneficiary are gone at the same time before you retire, then your contingent beneficiaries will receive the lump sum of the account value. I will say that even though contingent beneficiaries are not required, it is a good idea to name them, because if they weren't named, then we would just have to pay the account value to your estate. Your kids would eventually get it, but it would have to go through probate. It would have to go through the estate. Whereas if they're listed, we can just pay them outright. So.
Sure.
No.
I was just
So-
going to ask, my question was back to the beginning when you were talking about making sure that the school is using the right amount
Yes.
to report. How do we
Mhm.
verify that?
Well, that's a good question. I mean, I think first of all, you need to look at your pay stubs or your check advices, or however you look at that, because look at the gross pay and whatever that gross pay is made up of, then calculate the TFFR contributions. We can help you with that, but I would go to your school first, mainly because you're going to probably get a hold of them probably quicker than us. But making sure that they have those deductions correctly on their payroll software. So yeah, if you have questions, if you don't think it's being calculated correctly, check with your school, and then also you can try to check with us too. Yep. And we're going to talk about how you can contact us in a contact ticket. So.
Thank you.
Okay, now we're going to talk about, when we're talking about beneficiaries, we're going to go right into the yucky part of the presentation, and that's divorce. In cases of divorce, TFFR, your TFFR account or your TFFR benefit is generally considered to be a marital asset, and it's subject to valuation and division in a divorce. Now, the division or the splitting of the benefit requires a qualified domestic relations order. We call it a quadro. It is actually a document that you would have to have an attorney draw up. Or I would say your soon-to-be ex-spouse would have to draw up the quadro, or and the quadro. I mean, it's expensive because they're hiring an attorney. It does have to be approved by the TFFR board before being signed by the judge. The former or the soon-to-be ex-spouse may receive a lump sum only if you take a lump sum at termination. And which, by the way, they can't, alternate payees or ex-spouses, they can't come in and take half your account value. They can't do that. The only way they can get something from your TFFR account is through this quadro. And the only time they can get it is when you're eligible for early retirement, and that is at your age 55. They will, they would be able to get a lifetime benefit based on the accrued benefit at the time of divorce. And they could receive a benefit and you could continue working. So if you wanted to continue working until age 62 and they start taking a benefit at your age 55, I mean, that's fine. But then your benefit is going to be reduced based on the actual value of the alternate payee's benefit. So just so you are aware, if you are going through a divorce, or if you know of somebody that's going through a divorce, please, please, please call us first. We do want you to, the ex-spouse, to supply us with the quadro before the divorce is final, so that we can, comply with the quadro. And so, and just making sure that the divorce degree goes on, kind of complements the quadro, I guess is probably how I should put that. But that's kind of the yucky part of the presentation. So just wanted everybody to be aware of that. So now let's talk about service credit and how you earn service credit. And we're going to kind of maybe skip around this screen just maybe a little bit, but members earn up to 1 year of credit per fiscal year. Now, a fiscal year is July 1st through June 30th. Full credit is given for 700 compensated hours. In other words, if you, 700 hours, by the way, is about half time for a 9-month teacher. And so we're very generous with service credit, I would say, in North Dakota. Fewer hours, or in other words, if you work less than 700 hours, because we do have quite a few part-time teachers in the state of North Dakota, but if you work less than 700 hours, then you will get a fractional part of a credit. And so in other words, if you work 650 hours, divide that by 700, and you would get 0.929 year of service credit. So again, very generous with service credit. Service credit affects benefit calculations and is shown, and by the way, if you don't know how much service credit you have, it is on your annual statements, but also I believe you can just see it right on your member self-service portal, if you'd like to double check that. Dual membership. So I'm actually a dual member. I used to be a teacher, so I do have a small TFFR account. So I did teach for 5 years back in the 90s, but now I work for a state agency. So I do have the PERS retirement. And so service credit in TFFR and the Public Employees Retirement System, the defined benefit plan only, because now PERS has a defined contribution plan, but the old defined benefit, we use each other's service credit to get to that, to get to vesting and to get to that rule of 85 or rule of 90. And so we do have about a third of our membership that are duals. I believe we have quite a few duals on the call here tonight. But at retirement time, we will look at each other's service credit to get you to that rule of 85, like I said. Now, with dual membership, also we use each other's salaries. So whichever system has the higher salary, we will use that as well to calculate benefits, which is really nice. Not a lot of systems around the country will do that with our dual membership. So that's really nice. And what else? Vesting. So to become vested, members must earn 3 years of North Dakota service credit for Tier 1 members. For Tier 2 members, we require 5 years of TFFR service credit. So, so Tier 1, Tier 2, you have different vesting. I believe everybody on the call is vested, I believe. So another way to earn service credit is to purchase credit. Now, there are some rules and you know, before you can purchase service credit, but active teachers can purchase service credit. So you do have to be an active teacher to purchase. Yeah, so if you are thinking about stopping teaching and then purchase, you can't do that. So make sure that if you're looking at purchasing, you are purchasing it while you're active. Some things that are the types of service credit that you can purchase are the first one, they're refunds previously taken from TFFR. That's a big one. I know I took a refund from my TFFR account way back, but then I was able to purchase that back. And so we do have a lot of members that have refunded. When you come back, you can purchase it back. Airtime. Airtime is just time that's not related to any previous teaching experience. Some systems will call it generic time. The thing about airtime is that you do have to have 5 years of service credit on your record before you can purchase airtime. And then we limit you to 5 years of airtime. So first of all, you have to have 5 years of service credit before you can purchase it, and then we limit it to the 5 years. Now, as opposed to refunds, if you've taken 10 years of service credit out of TFFR, you can purchase all of those 10 years back. Same with out-of-state teaching, non-public teaching. If you have, you know, however many years you can verify of those teaching credits, you can purchase those. So we have out-of-state teaching, non-public teaching, leave of absence, legislative service, military service, and government agency teaching. The cost to purchase, that's always kind of the number one question. So the cost to purchase takes into consideration the final average salary at the time of the purchase, your current and retirement age, you know, and so whether you're, you know, grandfathered or not, the number of years to normal retirement, the increase in benefits that result in purchase. And so that's why the cost of purchase is, you know, quite costly, is because of the increase in benefits. Because again, the more service credit you have on your record, the higher the benefit. And then the other one, that fifth item there, the loss of contributions from earlier retirement eligibility. Because to be honest, most people purchase service credit to get to that rule of 85 or rule of 90 a little bit quicker. And so you retire earlier, and then the plan loses out on the contributions that would be paid if you were to continue to work. So all of those figures, or factors, I should say, goes into the calculation of the purchase cost. Now you can purchase it with a lump sum of money, or you can make installment payments over 5 years. You can purchase service credit with personal money. If you purchase it with personal money and it's money that has already been taxed, when you pay that to TFFR, it goes right into your account, and we put it in the tax, or the already or the post-tax bucket. And what that means is when you get a retirement benefit from us, some of your monthly benefit will be non-taxable because you have this you already have paid taxes on some of your account value. Now, a lot of people or most people that purchase service credit will roll money over from another eligible retirement plan, such as an IRA or a 403B. Sometimes it's a 401A. Rarely do people have 401k plans, but sometimes they do. And so we will take rollovers. And if that is the case, then that goes in the tax deferred bucket. And then when you receive a retirement benefit from us, again, you will have to pay taxes then at that time. Let's see. I should say, I'm going to kind of go back up one screen because military service. So all of these other types of purchases are calculated on an actuarial cost basis, with the exception of the military service. So that can be, or I should say, it may or usually qualifies for a reduced cost. But that is kind of a big subject area, is the purchase of service credit. And again, you can go onto your account and I'm going to just kind of show you where that is. In this tile, where is it? Purchase service credit. Click on that tile and then you can create a service purchase estimate. I will say, or I will warn you that every time you create one, it kind of hangs out there for a long time. Denise, correct me if I'm wrong, but do service credit purchase the estimates hang out there, or is that just the benefit estimate? Do you remember?
The purchase estimates hang out, I think, for 90 days.
Oh, 90
from
days.
creation
Okay.
date.
So that's better than forever. So that's where you can go to estimate a purchase, cost of purchase. Did I forget anything, Denise, on that?
No, I don't believe so.
Okay. Any questions on purchasing? You see any hands up?
I don't have any questions in the Q&A, and I don't see any hands up. I will add that again on the TFFR member webpage, there is a purchasing service credit accordion, and there are some links and resources that are available in there. And again, if you struggle with that, Denise, once you hover over with your mouse, if you can, the contact us tile, it's the last tile on that screenshot that looks like
right
a
here.
phone. That's the tile that's the I can't figure this out. I need to reach out to TFFR, and it is 5:44 and it's after hours and they're not answering their phone. So how do I reach them? And so that is your help button. So that's where you can reach out to us and put in a request so that one of our staff can get back to you with assistance.
Okay, sounds good. I will say that just kind of another thing. We can't advise on whether you should purchase service credit or not. We can give you, we can help you with the cost and that sort of thing and help you with, how much you need to purchase if you want to hit the rule of 90 on this date or that date, things like that. We can't tell you if it's a good purchase or not a good purchase. I will tell you that in my experience over the last 20 plus years, and I've done hundreds and hundreds of purchases, there's only been a handful of people that'll actually purchase service credit and if they already have the rule of 90 or if they already have the rule of 85. So most people are purchasing that service credit to get to the rule of 85 or the rule of 90, not the rule of 85, I should say, because they're already kind of over and done with, but the rule of 90 quicker. Even though it does increase your retirement benefit, it does cost, it is a little costly, and so you kind of have to look at how much it's going to cost versus how much you're going to get out of it. And so we can give you those figures. We just can't tell you if it's a good purchase or not, or if you should purchase or not. So Okay, let's go on to the good stuff, and that is the benefit and what you, as a teacher or soon to be retired teacher, can get out of your teacher retirement account. Okay, so to be eligible for a retirement benefit at some point, you must be a vested member. So again, tier 2 members or tier 1 members, you need 3 years, tier 2, you need 5 years of service credit. You must cease covered employment. And what that means is you must resign from all of your positions, with your school, or if you don't resign, 120 days has to pass. Now that's not on this screen, but because over the years we've had a few people that just don't want to send a letter of resignation, but then you just have to wait the 120 days, but you do have to, you cannot be active in order to collect your retirement benefits, I should say. We have a couple of different classifications of retirement, and I'll try to explain each one of them. So deferred retirement, that's where vested members can go inactive. So in other words, you stop teaching and then you defer taking your retirement benefit to a later date. So that's just called deferred retirement. Currently, we have, I think, about 2,400 vested members that are deferred in our plan. Reduced retirement, that is available to all tiers at age 55. So the reduction, though, is different for tier 1 and tier 2 members, or tier 1, actually tier 1 grandfathered members. The reduction is 6%. The tier 1 non-grandfathered and the tier 2, you have an 8% reduction in your retirement. And what that means is an 8% reduction away from normal retirement. So it is a little bit of a reduction to you. So reduced benefit starting at age 55 for all tiers. If you want to retire under normal or full, or in other words, unreduced retirement, for tier 1 grandfathered, you do have to meet the rule of 85. And when we talk about the rule of 85, hopefully everybody on the call understands what the rule is. But if you don't, what that means is your age plus your service years or your service credit that you have with TFFR. If that equals 85, then if you're a tier 1 grandfather, you have met normal retirement and you can get normal retirement benefits and there's no reduction on that. Tier 1 non-grandfathered, you have to meet the rule of 90. Again, in other words, your age plus your service credit needs to equal 90, but you also have to be minimum age 60. And so that was part of that 2013 legislation. Tier 2, again, you need that rule of 90 and minimum age 60. Then you will have normal retirement. And an example of that is, let's say and if you just think about it, once you have 30 years of service credit, so whether you teach 30 years, and you've gotten the full service credit every year, or you've taught for, let's say, 28 years and you purchased 2 years, or you taught for 20 years and you've purchased 10 years. So if you have a total of 30 years of service credit on your record and you're age 60, you will have the rule of 90. Now, many of you will hit 30 years of service credit before you're 60. And so that's where the deferred retirement may come in. So you may decide, once, let's say you're 56 years old and you have 30 years of service credit, and you decide you don't want to teach anymore, well, then you just wait until age 60 and then you have the rule of 85. So as long as you have that 30 years, you'll have that rule of 90 at age 60. Some of you won't hit the rule of 90 until you're 62 or 63. Some of you will hit age 65, and so that's that last bulleted item there. For all tiers, age 65 is considered full or normal retirement. So if you're one that started teaching late, or maybe you're retired in a different state and you're working in North Dakota, and you only have 10 years of service credit and you're 63 years old, we're not going to make you work until, you're in your 70s, until you hit that rule of 90. At age 65, that is considered normal retirement. So as long as you're vested, then there won't be any reduction in your benefit after, starting at age 65. The benefit formula, and it's easy to calculate. You can do it yourself, actually on a calculator, old style calculator, but the benefit formula is the monthly final average salary times a service credit times a multiplier. So every defined benefit plan has a multiplier. Back in 2001, we were lucky enough that legislation passed the 2% passed our TFFR bill, and we got that 2% multiplier in. And thank gosh we did, because that was early in 2001. That drives your benefit up. I will say that a 2% multiplier in a state where you also are eligible for Social Security, that's a pretty high multiplier, equals your single life annuity. Final average salary times the service credit times a 2% multiplier equals the single life annuity. Oh, I know. I was going to say, 9/11 happened later on that year, and our TFFR fund, as many other retirement funds, kind of tanked a little bit. And so I don't know that we would have gotten that 2% multiplier had it not gotten in before 9/11. So that's good. It makes your benefit, what it is today. So that's good. Now, there's that asterisk there by the final average salary. So if you're a tier 1 member, you calculate your final average salary. It's your 3 high fiscal year salaries. Again, fiscal year July 1 to June 30th divided by 36 months. Or if you're a tier 2, the high 5 fiscal year salaries divided by 60. Keep in mind, you summer school teachers, if you teach summer school and it goes into July, that's a new fiscal year. And so sometimes it's a little bit harder for you to calculate that, that fiscal year. So just kind of keep that in mind. When you retire, you have all of these different benefit options to choose from. These are all of them. We're going to talk specifically about them in the next couple of slides. But we do have joint survivor options, certain in life options. And so the first one there, refund of account value. Everybody who stops teaching does have the option to refund the account value. Well, what does it include? It includes your employee contributions, not the employer contribution, but the employee contributions. There's probably many of you on the call that work with an employer, or who have worked with an employer that have paid those employee contributions for you. And those are your Model 2 schools. So I'm sure we have a few of those on the call. But regardless of if it's coming out of your paycheck or if the school pays for it, it's 11.75% of your TFFR eligible salary. And your account, for as long as I can remember, it's been earning 6% interest. That's probably been in effect for about 40 years. It does take legislation to change. So your account has been earning 6%. And so that's what you can get if you take out your account value. And why does that matter? Well, if you leave employment, you can roll it over, or you can take it in cash. And of course, if you take it in cash, we have to withhold the 20% for taxes. If you pass away, then your beneficiaries can receive your account value. Now, this last item, think of your account value as a record of what you've put into the plan and not what you'll receive. And what that means is when you retire, almost all of our members will, unless they pass away early, will receive far more than the account value, because you get a benefit for life. And we're going to talk about that here in the next few slides. So the single life annuity, now again, I'm going to kind of go back up here. We have single life annuity, the joint survivor options, and the term certain in life. Each one of these options right here give you or provide you a lifetime monthly benefit. They just protect your beneficiaries differently, and the amounts are different. So the single life annuity is the highest amount paid to you. Again, it's payable for life. There's no monthly provision for a beneficiary. So if you pass away before receiving the full account value, then your beneficiary or beneficiaries will receive a lump sum payment of the balance. With the joint survivor options, we have 100% joint survivor and a 50% joint survivor. Both options are payable for life. They're both actuarially reduced based on your age and your beneficiary's age. You can only choose the joint survivor options at retirement time if you have one primary beneficiary. And the nice thing about the joint survivor options is that if they pass away before you, well, that's not the nice thing, but if they do pass away before you, then we pop you back up to that higher single life annuity. And not all retirements have that, actually. I don't think railroad retirement has that, and there might be some federal retirements that don't, but that's a really nice feature. So in other words, for example, let's say your single life annuity is $4,000 a month, and you select 100% joint survivor, and your spouse is about the same age as you. Well, your monthly benefit might be $3,600 a month. So again, you take that reduction, and when you pass away, your spouse or your beneficiary will receive that same amount for the rest of his or her life. So it's a lifetime benefit for both you and your beneficiary. If your beneficiary is not your spouse, then they have to be within 10 years of your age. If it is your spouse, they can be any age, but if it's not the spouse, they have to be within 10 years to do the 100% joint and survivor. Now, the 50% joint survivor, that's again where you take a reduction. So again, that $4,000 might be $3,800 to you. So if you pick a 50% joint survivor and you have your spouse who's about the same age, you might get $3,800 a month. And when you pass away, spouse will receive half of that. So what's that, $1,900 a month? And again, your beneficiary can be any age. So you can do a joint survivor with a child. You can't do 100% joint survivor with a child. And again, there's that pop-up feature with the 50% joint survivor. I should mention also that if you pick a joint survivor option at retirement time, and let's say a few years go by and both you and your spouse or you and your beneficiary are killed in a car accident, your contingent beneficiaries, if they've been named, can receive whatever is left in the account. And by the way, your account value will zero out in about 4 to 5 years after you retire. So the account value has zeroed out, but again, with the single life annuity and the joint survivor options, you get a benefit for life. Now, the 10 or the 20-year term certain life work a little differently than the 50% and the 100% joint survivor. So again, your monthly benefit is actuarially reduced. And I can tell you that on that $4,000, let's say, if you pick a 10-year term certain in life, your monthly benefit might be $3,900, something like that. The 20-year term certain in life might be maybe $3,800 or less. Or I'm sorry, about $3,800 or less. Again, both options are payable to you as the member for life. There is no pop-up feature in the term certain in lives. In the 10-year term certain in life, if you as the member should die within 10 years of your retirement date, your beneficiary or beneficiaries, because you can choose or you can have multiple beneficiaries with the 10 and the 20-year term certain in life. So if you should die within 10 years of your retirement date, your beneficiary or beneficiaries will continue to receive that same monthly benefit for the remainder of the 10 years. So if you're getting $3,900 a month and you pass away, let's say in 6 years, and you've chosen the 10-year term certain in life, well, your beneficiaries then let's say you have two beneficiaries. Your two beneficiaries will split that $3,900 every month for 4 more years, and then benefits will stop for them. So that's what happens in a 10 or a 20-year term certain in life. 20-year term certain in life, you're going to take just a little bit less money to have another 10-year protection for your beneficiaries. Again, there's no pop-up feature for the term certain in life. We also have what's called the partial lump sum option. A partial lump sum option will provide a cash payment in exchange for a reduced benefit, and it's an actuarially reduced benefit. It's roughly about 10% reduction from the single life annuity, or I guess any option, I should say. The lump sum or the partial lump sum is equal to 12 times your single life annuity. So again, let's take that $4,000 amount. So if your single life annuity is $4,000 and you choose the partial lump sum option, well, you're going to get about $48,000 in cash that you can take, but then we have to withhold the 20%. Or instead of the cash payment, maybe you want to roll that over into a 403B account or an IRA, and you don't have to pay the taxes on it because you're rolling it over. But then your monthly benefit will be reduced by about 10%. And then you still need to choose the benefit option. So whether you choose one of these term certains or joint survivor or the single life annuity, you can use the partial lump sum with all of those options. With the partial lump sum, you do have to retire under normal or full or unreduced retirement. So if you are retiring under early retirement, then the partial lump sum is not available to you. Okay, that's kind of, I would say, I would consider that as probably the most important part of the presentation are all of those options that you have to choose from. You don't choose it until right before you retire, but I think they're very important that you understand how they work. This next slide shows, it's just, I always like to see statistics. It's just a pie chart on the most popular option, and you can see here that the 100% joint survivor is by far the most commonly used plan. So followed by the single life annuity. We're not going to talk a lot about this, but we also have TFFR also provides disability benefits. I don't know, a lot of people don't know that, but to be eligible, you do have to have 5 years of service credit. You do have to be active when the disability occurs. You do have to make application within 36 months of ending employment, I should say. And you do have to be unable to perform the duties of a teacher. It does have to go through a approval process. It does have to be approved by the board, and it must be total. It can be temporary. So in other words, if you're disabled for 3, 4, 5 years, and then you get better, you can come back to teach, and your disability benefits will be suspended, and then you can retire again someday. But we do have disability benefits, so I do want to mention that. And the disability formula is same as the retirement formula. Final average salary times the service credit times the multiplier equals your disability single life annuity. You do have all of those other options available, like the joint and survivor and the term certain in life, but there is no age reduction in the disability formula like there is a retirement formula. We also have survivor benefits. So I did talk a lot about that when we were talking about beneficiaries, but death prior to retirement, if you're a non-vested member, because we didn't really talk about that. If you are not vested, then your beneficiary is required to take a refund of the account value. They can roll it over so they can avoid the taxes, or they can take it in cash. If you're a vested member, then your beneficiary decides if they take a refund of the account or the lifetime monthly benefit if there's only one primary beneficiary. If there's multiple beneficiaries, then they do have the account value then will just be split among the beneficiaries. And of course, if you were to pass away after retirement, the benefit is paid based on the retirement option selected that we just went over. The retirement process. So we're not going to go through that a lot. Oh, I guess there is a picture on there. But on your My TFFR member self-service portal on your home page, there is a tile called apply for benefit or apply for retirement. We want you to learn about your annuity options. So ask more questions if you didn't understand everything that I talked about tonight. Make sure you run a benefit estimate for your retirement date. Denise and Jamie uploaded one for you, but that may not be when you want to retire. Make sure you notify your employer of your resignation, at least 3-4 months ahead of time if you can. Review and update your My TFFR account member information, relationships, and beneficiaries. So all of these things you can do before you apply for retirement. And prepare to complete an application. Make sure you know when your retirement date is, whether it's June 1st or July 1st, because if you are done in May, you can have a retirement date of June 1st. If you teach summer school, of course you can't. Your retirement date will be pushed back. Or if you're an administrator working into June, then your retirement date may not be until June 15th or July 1st. Make sure you gather all your documents, such as your proof of age, letter of resignation, proof of beneficiary's age if needed, if you're going to do the joint survivor option. Make sure you get your bank information, the routing number and your account number. Make sure you know how you want to withhold for taxes. So whether you want to, if you want to withhold or not, and whether you want to withhold as single or married. And then we also have what's called a retirement checklist. Denise, I know we have some questions, but Denise, could you share that retirement checklist? Where's that?
Sure, I'll grab it here real quick.
Because
It's
that
on
is
our
found-
website
Yeah.
under the retirement application process. Sorry,
I'm going to share my screen because for the folks who may not be able to access Q&A or chat. So back again on that TFFR member webpage, when they go to retirement application process, it says complete the retirement application checklist. And Denise Langang Sargent actually is the person who put that together, and I just helped her clean it up. She did all the dirty work. So when you click on that link, there's a very handy checklist of all the items that you should gather and get yourself organized before you start the application process. Because once you start that application process, if you haven't gathered up all those items, you'll very quickly get frustrated. So.
Yes, and that is a really good checklist. That first page there is everything you can do before you retire, or before you make application. And I will say that we can't do anything with your retirement application until about February. So I would encourage you not to apply or not to submit that retirement application until then, if you're not going to retire until like June or July, mainly because we can't really do anything until then, but there's a lot of things you can do before then. And Denise, did you have anything else there?
I just wanted to mention too that the retirement application doesn't save. So if you aren't ready to submit it and you start it and come back and expect it to be there, it will not.
Yeah, we apologize for that, but at this point, we can't do anything about that, but maybe someday we'll be able to get it saved. But we have some questions. So Sarah, do you want to?
Yes, yeah, I was going to say, Angie, I turned your microphone off. You may need to unmute yourself, and why don't you go ahead and go first? And I've got another individual. I'm going to turn their microphone on or provide them with access. So Angie, go ahead.
Okay, my question was, you'd mentioned about teaching summer school. But when you teach summer school, do you get any service credit for that? Or is it just help your salary?
Yeah, that's a good question. So if you've already worked the 700 hours in that fiscal year, you don't get any more service credit in June. But if you work in July, that's a new fiscal year. So then that's when July 1 is when we start counting the hours for service credit. So let's say you work into July for summer school. And so let's say your retirement date's going to be July 15th or even August 1st if you work all through July. Then you're going to get a little bit of service credit for the month of July. But yeah, so does that make sense?
Yep. Thank you.
Thank you. Yep, good question. Okay, I think, Sarah, I'll just go on here. So the next slide here, the health insurance after retirement. So we do not here at TFFR have health insurance for our retired members. And so if you're receiving a TFFR benefit, and if you are going to be 65 and eligible for Medicare eligible, you may be eligible to roll in the PERS retiree insurance plans. And so, but if you are not Medicare eligible, we do have some resources on our website that can help you navigate that. I would also say, again, we can't advise on insurance options or anything, but most people will check with their school to see if what their COBRA rates are. So I don't know if you've heard of COBRA, but COBRA is an acronym for a federal law that says your employer has to keep you on their insurances for 18 months. And so you probably should check with your school to see what those COBRA rates are. Also check with your spouse, see if there's an option to go on to that spouse's plan. And then I don't know, what else to say about the health insurance, except you have to do your homework. And we do provide a few resources there on our website for health insurance options. Now, working after retirement, that's another kind of a big topic. We could talk for an hour on this, but we'll just kind of go over some of the highlights. So after you retire, you may return to TFFR covered employment under certain conditions. Now, you must wait 30 days after retirement. You cannot have any prearranged agreement with your previous school or another school to come back. So you have, in order to be eligible for retirement, you have to retire from all your positions. You have to sit out the 30 days with no contract, no written agreement in place, and then you can come back to work in a TFFR covered position. Now, keep in mind that our return to work program only applies to TFFR covered employment, and it does not apply to private sector businesses or non-public schools or colleges. And so you can go work as much as you want in those entities. If you do come back to work as a retiree in a TFFR covered position, and you're only out those 30 days, most people just return under the general rule. By the way, there are 3 different options to come back. The first one is the general rule, and you have an hour limit. So we don't care really about the pay or the salary limit, but you do have hourly limits. And so if you work a 9-month contract or less, you can only work, or you're restricted to work 700 hours or less. If you have a 10-month contract, you could work up to 800 hours. If you have 11-month contract, you can work up to 900 hours. And if you have a 12-month contract, you can work on up to 1,000 hours. Keep in mind, administrators who are on a 12-month contract, you do have to sit out that very first year for 30 days. So you can only come back as an administrator under an 11-month contract for that first year working 900 hours. And then after that, you can do the 1,000 hours. The hours exclude in-staff subbing, extracurricular duties, and professional development. Keep in mind that employer and employee contributions are paid on that retirement salary. So even though you're retired, you do have to pay those contributions on that salary. And of course, excluding the in-staff subbing, extracurricular, professional development. And if you do go back to teach and you fall under the general rule, even though you have to pay the contributions, your monthly benefit is not being recalculated. The next option there is the critical shortage area. So if you want to go back full-time in a critical shortage area, you do have to be out for 1 whole year, and that's that bulleted item C. So make sure that you are not even doing part-time work. So you can't even do the general rule for the first year and then do critical shortage area the next. You actually have to be completely out for a full year, except maybe extracurricular or something like that. The critical shortage areas are determined by ESPB, and all areas of subject areas are critical, except administration. So you can exceed the annual hour limit. So in other words, you can go back and work full time as long as you've been out for a full year. And again, you have to reapply for this annually. So every year you have to apply for the critical shortage area. And it excludes all the other extracurricular and professional development. And again, employer and employee contributions are paid, but it does not impact your monthly benefit. So on the general rule and the critical shortage area, retirees still collect their retirement benefits, but then they're working either part-time or full-time. We do have one other option to go back and work. This is typically not very many people actually use this option. So every year we have about maybe 2 to 6 retirees in benefit suspension or recalculation, but you can work more than the annual hour limit. In other words, you can work full time, but your benefits are suspended. The first month following the month you reach the limit, and they stay suspended until you re-retire. But the employer and employee contributions are paid. Basically, you become an active teacher again. But then when you re-retire, your benefits will be recalculated using all the years you were re-employed.